the opinion of EY. But I think that the reason I'm at EY is because there's a significant amount of overlap between what I'm on a day-to-day basis. So we'll cover that. We'll go over a few basics just around blockchains, why blockchains are kind of revolutionizing the financial industry, and then also what smart contracts are, how those are impacted. And finally, we'll probably have 15 minutes for a use case. We'll split up into small groups. Everyone will kind of come up with product or strategy they think would be a new product that a bank could offer to clients, and then we'll kind of talk through one or two examples. So big picture wise, this is EY's vision, but it's also mine. It's really the concept of Web3 and public blockchains fundamentally changing the way we exchange value, and will build a fair and more open working world. And EY's own personal brand is that EY is building a better working world. At one point early in my career, I said, how on earth is what I'm doing helping build a better working world? But once I kind of got into digital assets and blockchains, I realized, the power of open source is incredible. I mean, the transparency and ability to kind of build kind of on public blockchain infrastructure can actually change how the world operates, and it can make it more open, transparent, and really change the way we operate today. So hopefully at the end of this, you'll see how that's possible. Obviously, if there's people who don't think public blockchains can work, I think it's very contradictory to the way the financial system operates today. If you think about it, there's, you can see everything that's going on in Russia, and I don't know how many of you had followed kind of the Ukraine-Russia conflict when they cut off Russia from the SWIFT system, right? So the SWIFT system is really an international platform for how banks can transact. Large global banks actually have a messaging network which they use to send and receive assets. And so whenever the Russia-Ukraine conflict began, they actually disallowed Russian banks from integrating, and that was supposed to cripple their economy. So a lot of the financial infrastructure that we have today can be controlled and used as a means for government kind of control, and they can do it in a certain way that with public blockchains it becomes much more challenging, but we also view it as much more open. What's interesting is if you look at kind of the adoption timeline of where quote unquote crypto is today versus the internet. Obviously, you don't want to use past references as a predictor for the future, but I mean, it's pretty telling if crypto does continue on the traction that it has today to see how much adoption there may be in the future. If you look on the right-hand axis, you can see the total number of users exponentially starts to grow over time. And we're continuing to see this trend. I mean, we're working with the digital native and the traditional big players in the space, and they're all building the infrastructure. It just takes time. All of you have heard of Bitcoin. All of you have heard of Ethereum. There's also a component to this, which is generation. I think a lot of people who've been in finance for a long time, they don't like change. They don't want change. They think that there's tendencies that might mirror past instances of speculation and other things. So all kinds of reasons they think it won't work and they won't build for the future. So we'll see. I think one of the most telling and interesting quotes that one of our leaders in the US has is this quote around, it's not the strongest species that survives, nor the most intelligent. It's the most adaptable to change. And what's interesting is if you look at public blockchains and the way they've grown organically, just a community of members. Right? They're just building open source Ethereum. They're building Bitcoin. There's no government doing this. It's just a group of individuals continuously working together to kind of build standards and build out this infrastructure, very similar to the way the internet started. So I think we're really excited. We're finally getting there. There's still a very, very long way to go. So you might hear someone say, "Oh, I missed the boat. My Bitcoin I bought for $40. It's not worth 10,000." And it probably that may be one of a kind given how unique it is. And there's still a lot of speculation and scams and everything else that goes on. But I think it's very important to realize that we have a long, long way to go. So that being said, we like to, when we look at the internet, We really break it into three buckets: Web 1, Web 2, and Web 3. So Web 1 was really your Yahoo, your Jeeves, your Google. It was really read-only content. So they would share information over the internet. You would consume it. Really, there were centralized companies, like I was saying, Google, Yahoo, etc. And they were content providers that made advertising revenue. You looking at Web 2, that was the move towards social platforms, which was kind of a shift probably over the last 5 to 10 years. We were kind of moving to the Web 2 where it was read and write. You could create content, share it with others, and you could also just ingest platform, or you could ingest information on the platform. The big players there, obviously being Facebook, consuming and buying out a lot of these. Twitter, you're seeing all the Elon Musk news still going on. So they're still very relevant to us. But what we kind of see the future of where we're moving is really towards Web 3. And the unique thing about Web 3 is the ability to read, write, and own. So when you have a network which you can build, you can issue and track, and you can verify that I did something, that I own it, see every transaction that it flows through, you have the ability to own that data and that information and profit from it.
Why there's a lot of people that are very excited around the use of NFTs. There's been a lot of speculation in the space, but I think a lot of content creators, in the arts and other areas where artistic talents normally aren't recognized, or there's music industry, etc. They're very excited about it, and I think we're kind of seeing all of the puzzle pieces kind of fall into place around Web3. One other thing is really the monetization model it's decentralized commerce. So there isn't a central authority. It's each individual can own their own rights and kind of operate in this space. And the blockchain is actually the system of record that operates and allows that to happen. So what's interesting is if you look at kind of the stack, if you look at the internet, it had TCP/IP, and then it had some protocols that allowed for things like email, SMTP, HTTP, and other protocols, which unlock the ability for digital media, social media, e-commerce. Those are kind of the building blocks of the internet that we have today. Really what we're seeing is from a shift from internet of content with just ingestible information to an internet of value. So if you look, you still have the internet kind of as your base layer, but you actually have the blockchain, which operates as a settlement and transaction layer for financial transactions. And then on top of that, you build your standards, so standardization of things like money, music, assets. And then you actually have on top of that, you have things like decentralized finance. You have supply chain traceability. And then one of the hot topics of 2022 was the metaverse. So the metaverse actually should probably sit even on top of decentralized finance and supply chain. Really what the metaverse normally encompasses is a VR component combined with kind of all of these other building blocks to where your real world experience can be, have a digital twin that actually has, ties back to the real world in a legally enforceable and traceable way. So because you can tokenize money, because you can tokenize real estate, because you can tokenize all of these other things, your virtual reality now becomes very, very real. Imagine if The Sims, everything that you did in The Sims actually tied back to what you had in the real world. So it's a very powerful concept. I don't know if everyone's seen the Facebook news around they're losing money hand over fist right now, trying to kind of build out their metaverse capabilities. I think they see it as a new frontier, and they're right. I think the timing of what they're trying to build is just too soon. So the analogy that I've used before is they're trying to install a toilet without any plumbing. So the plumbing is the blockchain infrastructure, the wallets, the nodes, the connectivity, everything that allows the metaverse to actually work and be more unique than just some other alternate reality. Like everyone's already had VR, everyone's already had AR. All those exist today. So what makes the metaverse unique is the ability to, when I go into a metaverse store and actually buy something, money is actually moving underneath the blockchain, right? It's real, and the pipes just aren't there yet. So we've had a lot of clients trying to say, oh, we want to do NFTs, we want to do metaverse, and I think what we try and tell them is it's too early. You got to wait. You got to kind of build out the foundational capabilities, which we'll get into with the blockchain components later. And then on the what is a digital asset? We like to use the term digital asset. I think there's still a long way to go with defining key terms across the space. So people just use terms loosely, crypto, stable coins, they use, digital assets, things of that nature, but there's never a standardized format. We are seeing standards develop. So if you look at what Goldman Sachs actually just came out with recently, they're trying to build a standardized index library for various types of assets so that everyone is kind of speaking the same language. What's hard is crypto is global, so you have European regulators defining things, you have US regulators defining things, you have Asian regulators defining their own things, so it gets very challenging if they're not aligned, and that's another thing that's been a headwind to adoption, is just not clearly defining those. What we like to think about in order to, just bucket these things mentally when you're looking at them is when you look at a digital asset, you look at, is it fungible or non-fungible? And that will kind of be the first hurdle that we'll look at. So fungibility means, is every token that you hold, so every Ethereum, the same as every other Ethereum? And the answer to that would be yes. If it's non-fungible, you would say, if I hold Ethereum 1 and I hold Ethereum 2, are there different features that each one of those might have embedded, within the token or the smart contract that's behind it? If the answer is yes, then you may be looking at a non-fungible token. From a fungible perspective, we kind of bucket them into four categories here. There are definitely more than these four, but these are probably the most commonly discussed and talked about areas. So crypto, I think this is the origin of really where public blockchains and cryptocurrency started, obviously with Bitcoin and Ethereum being the two kind of major digital assets. Those are what we refer to as native cryptocurrencies. So when you have a blockchain, the way that it works is it's distributed among peers. You have to make transactions, and you need an incentive for a subset of validators to add new transactions to the blockchain. So these are really they're used to pay for fees on the network. In some cases, you can also vote using them in certain circumstances, but those are very different than a governance token, which, if you think about it, you have your base layer, your protocol, or your blockchain. On top of that, you may have a protocol, which has a bunch of smart contracts. So if you've been in crypto for a while, you might have heard of Uniswap or Aave or Compound, some of the bigger decentralized protocols. Those, a lot of times, they're trying to be decentralized. So what they do is they issue all these tokens, and they say everyone that holds this token has the right to vote, and so that you can make changes and vote on the protocol. So those we generally refer to governance tokens, and also those are very scrutinized by the SEC, right? Like if you think about a governance token, what's the difference between a governance token and a stock? Right, stock allows you the ability to vote. You get a return on it. In some cases, you may get interest. You have unrealized gain or loss just by holding that asset. So it's unknown where governance tokens will land in the long term. But definitely, that was really a new addition. I think in 2018, 2019, they kind of came out with that. But when you look at why that came up, it was because these protocols that were claiming to be decentralized needed a way to continue to function. So they said, okay, instead of our development team just centrally managing all of this, that's not decentralized in any way. We're going to issue these tokens, and then we're going to try and have everyone vote, and maintain this protocol. So they wanted to give the power to the users. So that was a new concept. I think those models are changing. It spawned the era of DAOs, if anyone's heard of those, decentralized autonomous organizations. And there's a lot going on, but it's very hard to maintain open source software. It's just a new challenge that a lot of people haven't had to encounter from a business context. Then lastly, you have utility tokens. So those tokens will actually be used on the protocol to get a service. So if you think about Chainlink, for example, Chainlink is an oracle. Really what they do is they provide off-chain data to protocols on-chain. So if I need, if I need the S&P 500 index price as of whatever date, I can pay Chainlink in their link token to continuously get that price on a predetermined basis. So there's a lot of utility tokens, and there's a lot that will actually combine governance and utility, which even gets harder to do. Stable coins, I think that they've gotten a lot of press. So if you look at DAI, USDC, USDT, really what those are trying to do is serve as a fiat on-ramp. So all of them are backed by something. USDC, USDT are backed by US dollars. DAI is backed by crypto. But really what they're trying to do is be a stable asset so that you and I can send, receive, buy things with a stable unit of account. Imagine, you're trying to go buy, gas at the gas station with Bitcoin. It may take half a Bitcoin at one point, and then if Bitcoin doubles in price, it may take a quarter of a Bitcoin, and if it halves, then it's going to take two Bitcoin. Like, you can't have a medium exchange that fluctuates that much. So what they ended up doing is coming up with these these types of stable coins, which are supposed to act as the medium of exchange on blockchains. CBDCs are really just central bank digital currencies. So in response to Bitcoin as well as the issuance of stable coins, central banks around the world, I think it was at above 85% over a year ago of central banks were looking at these new payment rails and saying, oh wait, like if there's an open source network that has its own currency, then how can we conduct monetary policy and fiscal policy, and how can we ensure that we continue to have the tools that we have today? A response to that was, let's see if we can, create our own digital currency. The leader in this space is actually China. They've developed a pretty sophisticated digital yuan. I think they've been in pilot for about 8 years. There's a lot of reservations around how viable a CBDC is and how much power it gives to governments around the world to monitor and censor its citizens. So there's a lot of political dynamics to CBDCs. The U.S. is actually, they've held back on saying a CBDC is required. I think just given our political structure in the U.S., we normally lean towards, private enterprise kind of maintaining a role. So I think the committee is still out on whether the U.S. will issue a CBDC, but it's a very interesting kind of dynamic that was prompted by, crypto and stable coins and the adoption there. The last two, security tokens and non-fungibles. Really, security tokens is more broad, so it can be, digitized version of real estate, digitized versions of, and the reason we use security tokens here is because if you tokenize all of Apple stock and then you could trade it on public blockchains, that would really be the example for the security tokens. If you think about bonds that are issued by the U.S. Treasury, that you can tokenize those and trade them on blockchains, all of them being the same. And then for non-fungibles, that could be things like art, metaverse land, and in-game items. So there are a lot of digital assets. I think normally people use the term cryptocurrency to think about all of these, and they all have different regulators and regulations and items that you need to consider. So I would always, when you're looking at something, I would always try and bucket it into, what actually am I looking at? How does this operate? What's the purpose of it? What is the platform? What governs it? Those are very important things that people just take for granted. We do have a polling question here. It's around a unique piece of art represented as a token on chain would be categorized as. Does anyone want to take a guess on what those would be categorized as? So I'll give you a hint. The unique piece of it means there is nothing else like it. A or B? Would anyone like to yell out an answer? You are correct. That is non-fungible. That means there's no other token like it. And there have been a lot of new types of digital art, so it's been cool to see that. Where we are today, I think this is important. Like I said before, we have a long way to go in this space. We've done some amazing things. We've built some amazing things. Since the launch of the Bitcoin network, I think we've come a long way. But if you look at it from really three lenses, the technical maturity, regulatory maturity, and the business maturity, technical-wise, I think there's been a steady progression of trying to solve for scalability, privacy, and security. So this really gets at how do you build an open source platform that has all of these features. Normally, all blockchains will have trade-offs. There's something called the blockchain trilemma. If you ever have time, I would kind of look it up. It's really been, when you move from Bitcoin to Ethereum to Solana to Polygon to all the different blockchains out there, you'll see each of them makes trade-offs along the way. And what they end up doing is for the areas in which the layer itself may not be. So if you sacrifice and say, I actually want to have high degrees of centralization and high degrees of security, you sacrifice scalability. So that's really Ethereum, and that's why everyone said, oh, gas fees cost hundreds of dollars to make a single transaction to move $5. What's interesting is that's what spawned the need for layer 2 blockchains, right? So now there's a batching mechanism on top of Ethereum. Privacy, we've seen zero knowledge proofs come in and try and solve for those. Security, obviously everyone says, oh, once quantum comes out, all of the hashing algorithms used for blockchains are going to get taken down. So regulatory-wise, it's very interesting to see, accounting, regulation, legal classifications all coming out really over the last 12 months. So a lot of movement there. And then business maturity. A lot of this is just education. So people just don't know how to build business models and operate public infrastructure. So wallets, nodes, reporting, compliance, all this is new, and it's operating on new rails. So we've made a lot of progress there, but there's still a long way to go. Just to jump into kind of blockchains itself, there's really, three key things that we always talk about. Blockchain is software. The key thing to think about is it's a database and a network. So it is a database because it tracks, in some cases it tracks unspent transactions, which we call UTXO. In some cases it tracks accounts. So, and the assets those accounts hold. So if you think about it, it's just a ledger system, right? So it just says us in this room, we hold these assets, and when we buy and sell them, it just shifts and says, okay, I now send 10 assets to whoever, they send 10 assets to whoever. That's really the database that it holds, and the network is really the interaction around all of us. If you build a database and no one ever uses it, it's useless. I think that's kind of one of the key components that really gets overlooked. People build great database architectures, but if you don't have any adoption, no network effects, it's never going to get any traction. So that's really why Ethereum has done so well, because it has such a community built around it to really push it forward. One thing to note is, you can have blockchains that aren't distributed, so it's very important to realize that distributed ledger technology, DLT, is that, as I was alluding to before, all of us, we have a ledger that is tracking the balances and transactions among this party. If it's not distributed, maybe I own the ledger and then I record everything and I trust, and you all trust me. A distributed network is every single person in this room has a copy of that ledger at all times, and we can all verify that everything we do is accurate. So we can all keep each other accountable, and it's more secure. You reduce centralization, but that's kind of the power of what DLT is. There's plenty of blockchains out there that say, okay, hey, look, it's an open network, anyone can join, but only those three over there can validate transactions. So how distributed is the network whenever we can all join, but really only three of them can validate. So it's a very important thing when you're looking at blockchains and decentralization to just look at what's the trade-off, right? Going back to what we were saying before. Consensus algorithm. So consensus is how we all agree. As I was alluding to before, we've all got a copy of the ledger, and there are batches of transactions that we need to agree on and say, okay, I can actually send I have $10 to send to whoever it could be in this room. I want to actually send it. Everyone in here will check and say, does he have sufficient funds? Did he actually sign that transaction properly? And we'll all validate it and say yes and confirm it, add it to the blockchain. So that's really how consensus works. So there's a whole different ballgame of game theory. If you've heard of proof of work, that's actually everyone is competing to solve a mathematical equation called a nonce to determine who can actually add the next block. So as I said before, on blockchains, transactions are actually, the reason they're called blockchains is because the blocks are just bundles of transactions. So if 50 of us, submit 75 transactions, we may take 15 of those for the next block, and then we add those into a block, we solve for the nonce, and if I'm able to solve for it first, I would say, hey guys, I solved for it, everyone checks my work, and then if it checks out, we add it to the blockchain. So consensus is really the way in which you reach agreement. And then smart contracts are actually just, what they end up being, they allow transactions to be sent with rules. So they're actually just business logic in most cases. So if you look at Bitcoin was a fantastic payment mechanism. So it just really allowed people to buy, sell, transact with Bitcoin, the asset itself, which was supposed to be an independent money in and of itself. Really what Ethereum revolutionized is the ability to expand beyond just payments and say, hey, we actually have really smart automation that we could do with business logic to say, if this happens, then do this. Do not allow this to happen if this occurs. And all kinds of different if functions that you can build into smart contract logic, which we believe is actually probably more important than the idea of just a new payment rail. So it's very interesting to kind of see that. If you look at kind of a world without distributed ledgers, I alluded to this before, the way the world works today is if we all owned our own company, we all have our own infrastructure that operates kind of in a walled garden. We all keep our own ledgers of assets and liabilities and income, revenue. And really the way that we gain comfort is you have regulations that you're forced to do, and you have independent third parties that come in and kick the tires and say, are you lying? And then that's really what the audit profession does today. It comes in and it will actually attest, and they're regulated. So it's the system of walled gardens and kind of third-party reviews that really build trust in the environment. And you also have a central authority. So a lot of times with money, for example, you have the central banks around the world that kind of hold the balance sheets of all of the banks within their jurisdictions. So the challenges are it's a very tedious process if we do have to all keep our own books and records, and then third parties have to come in. It's all very manual. It requires tons and tons of reconciliations. You would be amazed how many reconciliation banks have to do just for cash. Like to try and figure out if you are moving trillions and trillions of dollars a day, if you have cash breaks all over the place, it's unbelievable, and it's just unsustainable in some ways. So this all very much changes when you switch to a distributed ledger system. So if you think about it, we all have a copy of the global ledger. So instead of us all tracking our own independent ledgers and then sharing or having a central authority oversee that, we now have one large shared ledger, which is held and managed by all of us together. And then what's very interesting is that the consensus mechanism is really how we keep uniformity. So we all reach confirmation together, and there's something called the canonical chain. So the longest chain is the chain that everyone should build on. What's interesting is when you have a distributed ledger system, you'll see what it allows you to do is actually save bytes of data as you go along. So I don't need to retain the entire ledger at any point in time. I can actually save the latest ledger because all of the blocks are, and we're not going to get into it, but they're actually linked together via what we call hashing. So the way blockchains operate is you have, like I said before, transactions that are bundled together, and then you have what's called a header hash, which is really just the output of all those transactions being put through kind of a cryptographic algorithm. And then that hash is actually included in the next block, which then gets hashed, and then the hash of that one gets included in the next one. So all of these blocks of transactions are linked together in a way that if you went back in time and changed one transaction, one amount, one person, one destination, every block would change. So that's what makes the concept of immutability so strong in blockchains, because you have certainty that no one has gone back and tampered with the transactions. So it's a very, very powerful concept. The only bad side about that is if you mess up, if I send the wrong amount of assets, I can't go back and change it. Like I can't fix it, right? So that's where it becomes, immutability becomes really challenging. So you have to build in a million checks and balances around how you can ensure that it actually operates. This kind of gets at the example I was alluding to before, where instead of we all have a shared ledger, we're just managing a Google sheet. We can only add transactions. We cannot remove or modify, which is that concept of immutability. Anybody with internet access, can join in and add in transactions we would all verify, and we all have a copy. So at the end of the day, that's what public blockchains are. And that's why they're very simple in some ways and not so simple in others. We touched on this before. Not all distributed ledgers are public blockchains. One of the requirements of distributed ledgers is this idea of consensus, right? If you just have a single centralized party that's kind of in charge of validating transactions and adding and removing them, it's not a public blockchain. You may, in some cases, what public blockchains will actually do is they may start centralized. They may start with 10 validators, and then they'll say, okay, we're going to shift to 100. Okay, we're going to shift to 1,000. Okay, we're going to get completely open source. Anyone can validate. We've actually seen a move towards proof of stake. So if anyone heard of the Ethereum merge, they actually changed from proof of work to proof of stake. That was probably more of an efficiency play. So they wanted to make sure that they were, efficiently and able to process transactions. Proof of work was getting a lot of scrutiny for the amount of energy that it takes to compute, because you're doing highly intensive mathematical kind of plug and play. So you're just guessing numbers over and over and over again for proof of work versus proof of stake. Each of us has if we all hold tokens, we all hold different percentages of the total. What that ends up doing is we'll run a round. So we'll start what's called a round, and then we'll run a random selection, and then it'll say, maybe I win this round, I get to produce the next block. But it's all based on the percentage of the governance token that we each hold. So if I hold 5%, I have a 5% chance of being selected. There could be a scenario where maybe this entire group on my right side says, okay, let's band our tokens together so that we end up having a much higher chance of getting selected, and we actually maybe we'll split the earnings 50-50 kind of among the different participants. Like that actually does happen. So very interesting to see how consensus is changing. One of the key differences, we touched on it already, is data structure, participation, and then the consensus style. So there are even centralized consensus algorithms. There's things called proof of authority. So as I was alluding to before, if I create a blockchain, and we've seen a lot of governments look at this method. If I create a blockchain and I say, I only want these 3 banks, which are, these are state banks, I trust them, they're going to be the only ones that can validate transactions. That's a very, very viable solution that may come into existence. So the U.S. government may say, we're going to create a public blockchain, Bank of America, JP Morgan, they're the only ones that can validate transactions. That would be what we call a proof of authority, but it's technically not a public blockchain because it's not everyone can participate in consensus. This is an example. So as I was alluding to before, you have the header hash, you have all of the data, which would just be transactions of who sent what, and it's chronological, right? So you add a new block to the chain, and they're all linked. An example of what a non-chronological blockchain would look like would be a DAG or a hash graph. So you can see kind of how the nodes and the events, it's tracing across all these different, different transactions, kind of how those operate. So 2 very different models, both distributed in some ways, but 2 very different types. I think we can skip that one. Consensus mechanisms, I think we've touched on proof of work, proof of stake. There's a new thing called delegated proof of stake and proof of authority I kind of walked through. What's interesting is, when you look at consensus, it's really how the nodes agree on a common state. So state is really who owns what at what point in time. So we all need to agree how much money each of us has, and we have to reach that agreement before we move to the next block. So we have to agree on the state at that point in time. The nodes have to decide who will update the ledger. So a lot of cases, like when I was saying with the proof of stake, we run a random algorithm that picks a person to do the next block based on a percentage that we each hold. So if we run the algorithm right now and it says, it's my turn to choose a block, that's how we actually come up and decide that. In proof of work, it's the first person to come up with, a solvable nonce, or they come up with the correct answer, and then they just broadcast it to the network. That's how they decide who will update the ledger. And then also how they resolve discrepancies. So in blockchains, there's something called a fork. So as I said before, the longest chain is generally what everyone will use because it's normally the most trusted, right? It has the longest history of the majority of validators or nodes believe that that is the most accurate, then it is the most accurate. If there is a 50-50 split, then you might incur what's called a fork. So a fork would say, we think that this is the state as of a point in time, and then some other group of nodes may say we think this is the state as a point in time. You might actually have two parallel blockchains. You have to have a method for how you resolve those discrepancies, and it differs blockchain to blockchain. But we actually haven't seen a fork in quite some time, but forks are also ways to update blockchain networks. So with the Ethereum merge, they said we're going to transition to a new blockchain. So they actually created a willing fork. Then all of the nodes and validators said this is the new chain, and that's how it happened. Challenges, obviously, there's power failures, blue screens of death. If we all, in order to actually maintain the network, we need to all be connected to the network and syncing at all times. So if half of us, our power goes out and we can't connect to the network, and the other half maintains power, they can pretty much do whatever they want until we get back up and we kind of are able to validate that those transactions are accurate. And it does take a lot of energy, at least for proof of work, to do that. So you're seeing, governments around the world are getting smart. So they're able to kind of track down where some of that energy efficiency is happening, or those energy bills are coming through, and shutting those down. For smart contracts, I'll make this really quick. Smart contracts are really just computer code that runs on blockchain networks. So if you think about it, what's the power of a smart contract? It's really just autonomous business logic that allows you to transparently operate functions that historically may have been extremely manual. This was the key difference between Bitcoin and Ethereum. So Bitcoin was really just focused on facilitating payments in a decentralized manner with no intermediaries. Ethereum was really meant to be a general purpose blockchain that says, hey, if you have this new business model, you can actually build these, deploy these smart contracts, and anyone can interact with them. So if you think about the concept of opening up finance and expanding who has access to financial, it could be lending, credit, borrowing, whatever it might be. This was really one of the key things that for a long time people said, hey, if we can build this on the internet and everyone has access, like this could be revolutionary. And we've actually pretty much seen that come to fruition with Ethereum. There's two types of accounts. So there's externally controlled accounts, which are, if you and I opened up a wallet, it will actually give us an account. So it will say, here's your public address, Aaron Stafford. I own this. I have the private keys. I hold assets in there. But there are also contract accounts. So when you deploy a smart contract on Ethereum, it actually has an account. It has a public address as well. And what it does is it can store balances, but it can also execute the code within it. So an example, and Ethereum has come up with what they're called, standards. So they call them ERC20. And so that's actually a token standard. So within that standard, there's 6 functions. So you can send, receive, you can allow someone else to, take assets from you. You can mint and you can burn. So you can create new assets or, destroy them. And those, 5 or 6 functions are really what was the basis for all the tokens that you see today. But those are just functions. And there are thousands and thousands of functions on Ethereum. So if you think about all the crazy things you can do and the business models you can create with that, it's very impressive. So what is a smart contract? A good example here is if you have, in the traditional world, if you have 2 parties, if they want to execute a contract, a lot of times, if I want to borrow money, I have to go to the bank. How does the bank operate? The bank takes in your deposits and creates money on the other side and lends money to me. That's actually kind of how the bank operates today. With smart contracts, what you can do is you can actually deploy logic that will allow you to lend to the contract and the contract to lend it to me. So the contract will hold your assets and lend them out on my behalf, and it's completely transparent. You can build in 100 different collateralization and liquidity ratios and all kinds of things of that nature, but the power of it is that it's it takes something that may have required, 4 huge institutions, hundreds of people, all of this, crazy operational intermediation before, and it just makes it simple business logic. And this is really what I think is probably the most important thing about blockchains that people haven't fully grasped yet is, like, sure, it's a revolution in payments, right? It allows us to say, I can send you money and I don't need a bank. Like, that's great. That's peer-to-peer. It's open. Like, if you want to say, I hate banks and that's what I want to do, great. I actually think that the most powerful thing of blockchains is the ability to tokenize all of these assets and then create business logic to create new services that are extremely streamlined and automated and transparent. So if you have a business and you say, okay, I'm going to be a lender, you can just design 10 smart contracts that will do all of that for you, and all you have to build is a front end to people to go in and click like send, receive, deposit, lend, and then everything on the back end functions. So if you look at all of the DeFi startups that are doing trillions of dollars or probably billions of dollars, they're doing that with 50 people, 25 people. If you look at a bank doing the equivalent amount, they have 10,000. So it's just the power in automation is very, very interesting. And the networks are open, right? So you have these highly automated workflows with open access and composability, and it's very, very interesting to kind of see how it goes. The hard part with smart contracts is security. So smart contracts are open source. If I'm a hacker, I can go look at the code behind the smart contract, and if I can exploit it, I can't. It's out there. Like, they can test it. They can do all kinds of different things. Anyone can interact with it. The solution behind that is there's obviously insurance. There's functions you can build in as safeguards, scalability. You got to be able to, blockchains aren't made to ingest and store data. They're meant to just record transactions. So if you have huge amounts of data computation or you need huge amounts of storage, the blockchains just aren't made to do that. So what you have to do is design your smart contracts to be very lean and only execute specific functions in very direct ways, or you have to be able to have offline storage, which we've seen things like Filecoin and others solve that problem. Upgradability, as I said before, when you deploy a smart contract on the blockchain, it's technically immutable. No, you can't go back and change it. The way we were able to solve this was there's actually an ability to have 2 smart contracts that operate where one smart contract just points to the location of the underlying. It's what we call a proxy. So what you do is you deploy both at one time, and if you want to change the contract, you just tell it to point to a new one that you deploy. So one of them never changes. All it is it just points you in the correct direction of which contract, and then you can just redeploy the underlying with new functions. You can change them, blah, blah, blah. So the industry has kind of solved that problem. The issue with that is you still have to govern that pointer contract and make sure it's secure. If someone takes over that contract and just points it to, a malicious contract or deploys a fraudulent contract, then you're in a lot of trouble. We can skip that one. One of the examples just around use cases that I think is important. We mentioned a lot of these, stablecoins, lending, exchanges, insurance, gaming is a huge one, real estate, identity, notarizing. All of these are being impacted in some way, shape, or form by blockchains. It's incredible to see the amount of innovation. Like I said before, I think the networks themselves have a long way to go. Like, it could be regulation, it could just be technical maturity. But it's very exciting to kind of see. And if it's something you're interested in, like, you can follow any of these topics and be an expert in 6 months. Just take the time to read up on them. It's amazing what you can do. So I know we have probably 15 or 20 minutes. I do want to get to the case study. So you can break up into small groups. Obviously, come up and ask me questions if you have throughout this. I think what we'll do is we'll give 15 minutes or so, or we'll probably give 10 minutes, just given timing. And then what I want to do is if one or two groups just would feel free to share. I think it'd be exciting to kind of just talk through, have I seen that before? Is that something clients are actually working on? But for the actual use case today, I think one of the key themes we're seeing everywhere is banking meeting Web3, right? Banking is probably the slowest innovative group in any industry. They're highly regulated. The payment systems that we have today are archaic. But we're seeing with the challenge of Bitcoin and stable coins and other things, banks are now feeling the pressure to actually, evolve and leverage this technology. So if you were to imagine the future of banking, think about blockchains and crypto and smart contracts and tokenizing everything in the world. And think about the disruptive impact to traditional financial banking. So imagine your Bank of America, JP Morgan. How could a bank leverage this technology to create a new product or evolve existing products? So what I mean by a new product is you may have the ability now to go out and create something brand new. You could take, money market funds that you tokenize, and you can take real estate and you can merge them together into a new type of asset. Tokenization allows for what we normally refer to as fractionalizing assets. So you can do micro lending, you can do all things, new kinds of products. Or you can evolve existing ones. So if you want to tokenize real estate and create a new market for that you and I can buy. So maybe we want to invest in a specific neighborhood. We think that neighborhood is going to be awesome. Today, the only way we can do that is go buy real estate. Imagine in the future, if you thought that was going to happen, you could just go and say, okay, here's all the tokenized assets for that. I'm going to buy, these 2 houses. I'm going to buy their tokens, and you would get an investment if they actually did increase in value. So if you come up with a product or a strategy that leverages one of the emerging techs, and also have an argument for how and why existing banks can leverage that, I think I do give some context here. There's really 3 ways banks can get involved. It's investing, offering, and building. So you can invest in crypto, you can offer access to crypto, or you can build new products and revolutionize your own business. I would probably think about it and choose, is it retail, commercial, investment banking, or custodial banking? And then some of the product examples about loans, deposits, credit, asset management, trade financing. Just think about how blockchains and smart contracts could change that. I know you're not all banking experts, so it doesn't have to be anything super sophisticated, but if you have any great ideas, happy to talk about them. And then I did list a few kind of key issues currently in the blockchain ecosystem to think about. So I'll give you guys probably 10 minutes, and then we can quickly talk through a few and ask any questions. But awesome. Thanks all. Okay, in the interest of time, I actually think I shortchanged you guys. I gave you about 5 minutes. All right, does anyone have any revolutionary, groundbreaking ideas, if you were a bank today, of what you would do from a crypto strategy standpoint? Anyone want to volunteer? No volunteers? I see you in the back. It's our computer scientist. I've got high hopes. Come on.
So the idea that I thought about was that if the investment funds, instead of not banks, if they had funds that instead they would be tokenized. So when you bought the tokens or like the shares of the funds, you would not only be a passive investor, but actually an active investor, as you would have these tokens that would represent voting shares. So in decision making of how to invest and how to allocate them.
So it's an active investment fund. If you were to, so you could tokenize the fund shares, right? So when you buy the token, so the way most investment funds work is you have an investment manager who says, here's our strategy. We're going to go out and do tech sector investments. We're going to do whatever it may be. They come up with some strategy, and then they have to go raise funds. Then they will go and they'll say, hey, do you want to buy into our fund? You would normally buy the shares and you just hold them, and that's equivalent. And they go up and down, whatever. But if you were, and actually, it's funny, I was working on a presentation today. We were talking to a large U.S. bank, and we were actually talking about money market funds. So if you take a money market fund, the investment strategy behind that is you have very, very risk-averse assets. So U.S. Treasuries, CDs, certificates of deposits, things that have very short durations, very low risk, and then you combine them all into a fund, and then you issue shares out to people, and they can buy them. So it's a very risk-averse item, and we actually had recommended that they tokenize it. But what does that token actually give you? Why is it better to tokenize it than it is to just do your traditional fund and have a share? Like, it's easy today. Like, what benefits do you have from a token? And so our argument was, today, if I tokenize that money market fund, I still have to worry about how I pay out my interest, how I pay them their distributions, how I work with corporate actions or anything of that nature. So if you have securities or anything in there, and there's things called corporate actions. So if someone does a stock split or someone does a stock buyback or anything of that nature, it's all very, very manual and it's very hard to track. So if you could take all of those operations, put it into a token, even taxes, for example, and then you could have that all automated. So it says, okay, anyone who buys this share, they're going to pay me X fee automatically. It's going to require they do X taxes. It's going to pay them interest on X date. Imagine you take away hundreds of thousands of people's of having to manually track all this stuff, and now you have it in a token. So to your point, you tack onto that a governance capability. So when I now have the token, all the operations are highly automated. So now I can also have a vote for, it's almost like an open investment fund, which there may be vehicles out there today that are similar to that, where I buy a share and that gives me a say into what we invest in. Like, normally you just do that by buying the share, you back the investment strategy behind it, but it could be an interesting concept of, like, if you wanted to have a community fund of you and your friends. I could get dirty, but yeah, you can think about it. It would be interesting to see. I don't think the governance has been something that people have looked at before, so it would be an interesting one to look at. I mean, it's definitely something we could propose. The only issue is you have investment managers who make a lot of money and are the smartest guys in the room. Why would they want to listen to you, right? It's like, let's see. They do make a lot of money, but yeah, it's different. Anyone else?
Yeah, I came up with a real estate blockchain network where we have like a proof of authority node network where we onboard existing registrars to digitize like their existing land deeds in the registrars. And then from there, individuals can go through KYC processes to sync their on-chain identities with their off-chain identities for verification purposes. And then banks can use our blockchain network to create decentralized applications specializing in mortgages, HELOCs, and basically a DeFi platform specializing in home finances.
So is it intended to, so the platform, so one, I would say from a commercial banking side, so if you look at the largest real estate commercial players, I think Wells is number one, Wells Fargo in the industry. They definitely, and when you look at real estate, there's a retail component, which is like you and I, our home financing, blah, blah, blah. Then there's commercial real estate, which is really like how do you finance massive, skyscrapers, et cetera. So there's kind of two buckets you can play in. I think to your point, it sounds like you were looking at the retail side of this for like home ownership, home financing. And I think what's really interesting that we haven't fully seen yet is actually the first bullet, first 1, 2, 3 bullets here of like there's transferable identity that allows, so we have credit scores today, right? So credit scores allow you to get certain financing on homes and interest, etc. If you were actually able to have verifiable identity that tracks your reputation and buys and sells on a public blockchain, could that impact how much you pay an interest on a loan? Because really credit is just the amalgamation of how much risk the other person is willing to take on. So they have to compensate you, or you have to compensate by paying them more interest, right? That's really how the interest rate system operates. But it would be very interesting to see. I feel like the current hurdle to that is the legal clarification around how do you tokenize real estate? How do you have legal enforceability if like I sell my real estate token to you, that's the title to my house. Like you need to have legal enforceability to where if I show up to the house and I say, hey, I have this token, it's legally enforceable, right? They might just say, I don't care about your token. you go to court, and then it's like, oh, that doesn't mean anything. So I think there's still a significant hurdle there. On the marketplace piece of it, I think micro real estate investments would be extremely interesting, right? Like real estate has proven to be one of the best asset classes in history for small individuals just looking to increase their net worth. Having access to that when you may not have, I mean, look at the real estate prices in Boston, and you're paying $600 to $1 million. Like not everyone has that to buy their own home or their second home, etc. So if you're able to have like micro real estate, it's at the concept of fractionalization, right? If you can take an asset, you can tokenize it, you can then fractionalize it into smaller shares, and people can buy and sell that as part of their investment portfolios, right? So we all have asset managers, so you can have a Morgan Stanley, a Charles Schwab account. They'll say, what is your risk appetite? What stocks do you want to buy? What bonds should you have? Now imagine if you had micro real estate as another option for your portfolio. It would be a very interesting thing to do. But it's gonna. I feel like it's a matter of it's gonna happen. It's just the building blocks have to be there. So both very interesting use cases. I will say it's just very hard to do it. Like banks and everyone else can't just go out and build these things and then just throw them out to the public, right? They have to get through regulation, legal hurdles. They have to build the technology to do it, partner to build the ecosystem. So everything moves extremely slow. Slow in crypto terms is like 6 months. Slow in banking is like 5 years. So it'll be very interesting. I think tokenization probably the beginning of 2022. I think tokenization took like a hyper focus. So it'll be, I would see in the news, in not too distant future, a lot of tokenization news. So it's going to be like your JP Morgans of the world, your Wells Fargo's of the world. They're going to be like, oh, we tokenized this and we're trading it on this platform. But what will be really interesting is when that translates to tokenization changes who has access. So right now, like if Wells Fargo tokenizes their commercial real estate, their same clients have access to buy and sell it just in a new form. But you and I don't have access to that. So imagine when you tokenize it, you fractionalize it, and you change the market. So it's like everyone has access to this, and liquidity moves rapidly. That will be when it really changes the game. But no one really knows what that would look like. But global liquidity is one of the terms we've heard for a long time. Of like, if you take all of these highly illiquid assets and then you tokenize them and you fractionalize them and you let everyone have access, like what does that mean? What does that look like? And so there's going to be a lot of new businesses, a lot of new assets, a lot of new types of stuff that can be created, good and bad. But no, I think those are both awesome use cases. I think we're up on time. Obviously, let me go back to the beginning. Feel free to connect with me. LinkedIn, if you ever have any questions around like my own, what UI does, around my own experiences, if you ever just want to chat about crypto stuff, just send me a note. I think you guys are coming out into the working world at a really cool time. There's just a lot of crazy stuff going on with technology and lots of innovation. It's kind of back like early 90s with the internet. So feel free to reach out if you ever have questions, but thank you guys for taking the time to sit and listen to me ramble, and I look forward to connecting. Thanks all.